Hey, how's it going? In today's video, I'm going to be telling you the difference between owning and buying the house and what you are potentially missing out just by owning a house. Now, what we're going to be doing right now is we're going to be taking a look at a property that is for sale at $245,000. This is a 3-bedroom, 1-bath, $1,400 square foot home. Now, what I'm going to go ahead and do in this video is I'm going to do a number breakdown on what it would be like to buy this house with a loan, in particular an FHA loan, and then what would it be like to rent out a house that is worth this amount. So to start us off, we first need to take a look into how much would it cost to rent out this house. Now, I'm just going to go ahead and get just a rough estimate, and we're going to be using rentalmeter.com. Now, for the median rental for this property around this neighborhood, we're going to be looking around $1,500. We need to keep in mind that every year we're going to be spending 12 times the rental income of the house. So if you can take a look at this Excel spreadsheet, we are going to be putting here at year 0, what is it going to cost to rent out the house? Normally, when you want to rent out the house, you're going to have to pay security deposit and first month's rent. However, what we're going to go do here is we're just going to go ahead and start us off with paying the security deposit only, and then just adding up all the monthly rents over a long period of time. So for this first year for us to own this house, we would be paying a total of around $20,000 just to rent out this house. Now, if we go ahead and we look at this in a 30-year time frame, we would be spending $541,000. And keep in mind, I'm not keeping into account any type of rental increases. So this is literally best case scenario on how much money you would be spending over a prolonged period of time just by renting. Now, what is the flip side? Well, the flip side is buying the house. Now, most people, they really don't like buying a house because they first of all think that it's either too expensive and they won't be able to afford it. Now, if you also think like this, the bare minimum you should do is talk to a loan officer and seeing how much you would qualify for in terms of buying a house. I'm also a loan officer licensed here in the state of Texas. So if you're interested in buying a house or getting a pre-qualification, please feel free to reach out to me via phone or email. Now, moving forward with this example, I'm going to go ahead and give you an idea on what it would cost to buy this home with an FHA loan. The bare minimum we would need to put down is 3.5%. So if we were to only put 3.5% down, that means the rest of the money would need to come in the form of a loan. So if we were to do that for this house, we would be taking out a loan for $236,000 and some change. Now, for the current market, let's just say the interest rate is around 6%, and we're going to be doing a 30-year loan. I already went ahead and got the property taxes, and I estimated the property taxes to be around $3,700. I also estimated the hazard insurance to be just a little bit around the value of the mortgage insurance. So that's why these numbers are very close to each other. So if we were to take into account the property taxes, insurance, principal and interest, and hazard insurance, all those values are going to be add up, and we are going to be seeing a total PITI of $2,055. Okay, the main thing we need to do is this: we need to compare what is the true money we are losing. So if we have a house that we're renting out, we are technically just losing all of that money. So what would be the exact same comparable when it comes to buying and owning a house? Well, believe it or not, that comparable would be in terms of the interest, taxes, and insurance that you would be paying on the house. Okay. So if we have our principal, interest, taxes, and insurance represented by this value right here of $2,055, how much money are we going to be spending out of that in terms of our interest, taxes, and insurance? Well, it's actually pretty easy. If you go over here to the right, I just did an amortization schedule, and here I just broke down how much money we are going to be spending in terms of our principal and our interest. So for the first month we pay this house, right, we are going to be paying $235 in terms of the principal, and we're going to be paying around $1,182 in terms of the interest. And this would be our new loan balance. Okay, so all we would need to do is get this interest value, right, and then add it with the monthly values it would cost for the taxes, hazard insurance, and mortgage insurance. Not only did I went ahead and did that for us, I actually went ahead and added up all the values that you would spend for each consecutive year you would own the house. So here's our second table that we need to take into account. So here I added up all the interest, taxes, and insurance you would pay just to own this house. Okay, and this would be for the first year. Now here, this is the principal you paid. Now, when you own a house and you have a loan on the house, you need to make sure you consider that house as a little bank, because when you take out a loan, whenever you make your loan payments, you're kind of depositing that money into the bank, because what ends up happening is you're paying off your loan amounts, and you also have a home value that the home is worth. So as you pay your loan off over time, you own more of the house, okay? Now, if we were to add all these principal payments over the next 12 months, or for the first 12 months that we own the house, we would have paid $2,900 in terms of the principal. That money just doesn't disappear. It just goes in terms of the form of the house, okay? If we were to take into account how much equity we have in the house, we need to consider this. If we were to buy this house with 3.5% down with an FHA loan, the down payment would have been around $8,500. And keep in mind, that money is just not lost. That is the down payment. That is the equity we now have on the value of the house, okay? So we would need to add that value with the principal balance that we paid, meaning that just from the base loan equity, we would have after the first year around $11.5 thousand, okay? Now, if we were to take into the total cost that we would pay in terms of the interest, tax, and insurance, we would be spending $21.7 thousand in terms of the interest, taxes, and insurance. Now, how would that compare if we were to rent out a house for $1,500 a month? For that first year, we would only be spending $19,500. So if we were to compare that to the interest, taxes, and insurance, that would be a difference of around $2,000. So the money that we're basically saying goodbye to when owning the house, I would say that would be a better comparison in terms of comparing what are the sacrifices between renting and owning a house. Now, the reason why owning a house becomes a lot more appealing is because you own a part of the house. And not only do you own a part of the house through the equity, you also get the equity appreciation of the total value of the house. So what does that mean? If we were to buy this house for $245,000, on average, property appreciation rates for the United States is 5.44%. So after us owning the home for 1 year, let's say that home is now worth $258,000. So if we were to stack that on top of our total equity on the home, we would now have around $25,000 in terms of equity of the house. So if we take a look at renting the house, when we own that house after a year, what's going to be happening? You just lose $20,000, okay? However, if you were to buy a house and the home appreciates for 5.44%, and you also deposit money through the bank, air quotes, the house, because you're paying down the principal, you now have around $25,000 worth of equity. And that's with you only paying $2,000 extra out of your pocket every year. Now, what sounds a lot better? Spending $20,000 a year and never seeing it again, or spending an extra $1,000 to $2,000 just to own the house. Okay, so that's what happens on the short term. What happens in a prolonged period of time? I already went ahead and did some voodoo magic with this Excel spreadsheet, and I actually came up with a value for net equity. Okay, so what is net equity? Net equity is not something that is very common. I really don't see anything on the internet for net equity. But I came up with this myself, net equity. So how do I define net equity? So here, if you just look at this equation, net equity is the total equity you have in the house minus the total cost that you would spend on the house. Okay, so that includes the interest, taxes, and insurance. And also in this case, because we did an FHA loan, the upfront mortgage insurance premium, which is $4,000 for a loan of $236,000. The moment we buy the house, okay, we are going to be having a net equity of $4,400. So what does that mean? To buy the house, we need a down payment of around $8,000 to buy the house. And we are basically spending the upfront mortgage insurance premium. By the time we own the house, we actually spent and lost $4,000 just to get the title of the home under our name. And I will disclose there are a whole bunch of other fees that I'm not including. But however, this is just to prove a point. So now what happens after the first year? Well, after living in the house for the first year, you're going to be paying $22,000 in terms of your interest, tax, and insurance. And then if you add on the upfront mortgage insurance cost, that's going to be a total of around $26,000. However, we will have around $11,000 in base equity. And what is that? That is a down payment for the house and also the loan balance we paid down. And on top of that, we have the property appreciation of the house. So the total equity there is going to be around $25,000. And we figure out the net equity, that's going to be $1,000 that we lost, okay? So the cost of living in this house is going to be around negative $1,000 theoretically. As you can see, on a year-by-year basis, on the worst year, which is the 5th year, we are losing $11,000 in our entire pockets. However, what happens when we go down further in terms of the years? Well, if we go down to the 10th year, we are going to be making $6,000 just by owning the home and making payments to the house. We take a look at the 20th year, we are now going to have $191,000 in net equity. And if we go even further down, 30 years, we are going to be having $700,000 in net equity. And that's also including all the costs it would be in terms of paying the interest, paying the taxes, and also paying the insurance. Now, what does that also mean? That also means we're going to have a total of $1.2 million in terms of equity. How can you compare buying a house to renting out a house? If you were to rent out a house and assuming that the rental prices don't increase, you're going to be spending out of pocket $541,000. However, if we were to flip that, how much money would we be spending out of pocket? At the bare minimum of us just making the monthly mortgage payments, we're going to be spending around $24,000 every year just to own the home. However, like we said, a part of your mortgage payment goes towards your principal, and you also get to ride the property appreciation wave. So what ends up happening is if you only take into account the interest, tax, and insurance, you are only losing around $506,000 in terms of the interest, taxes, and insurance. And then not only that, if you take a look at the home value, that home value is now going to be worth around $1.2 million. What ends up happening is by that time 30 years passes by, you're going to be owning $1.2 million of pure equity as opposed to just spending $500,000 in terms of just renting. Obviously, when you own a house, there are going to be more costs that you need to consider. If you are renting a house, you are going to have different pros and cons. And when you are renting a home, you're going to have different pros and cons. If we start off with the renting part, first of all, renting is going to be a lot more flexible in terms of what your options are. Because the main issue with buying a house is that you are kind of stuck with the house until you sell it. And there's no guarantee you're going to be able to sell the house within a short period of time. However, with renting, the only real sacrifice you really have is if you rent out a place, you only are locked in there for a year. And depending on what type of lease you do, you can probably even get out of the lease within a month, or you only need to sacrifice either your security deposits or other things. When it comes to renting, you have a lot more flexibility because at least you get to see the terms of the lease and you know what your potential backout methods are. However, with real estate, your only backout method is to sell the house or rent it out. The main pro with renting is first of all, it's a lot easier to get started with renting out a house as opposed to buying a house. Because when you want to buy a house, you do need to have around 5 figures of cash saved up so that you can at least do the down payment and pay for the closing costs for a house. However, that shouldn't stop you from trying to figure out what your financing options are. So once again, please go ahead, talk to a loan officer. If you're interested in working with me, I do own my mortgage company called Freedom Mortgage. Please feel free to reach out to me via phone or email once again. So the main point is renting out a house is just simply easier because all you need to do is really pay for the first month's rent and security deposit. So for a $1,500 home, you only really need to spend $3,000 to get into a home. Okay. However, here are the cons with basically renting out a house. First of all, as you can see from the example I was talking about, you don't get any equity. The longer you do not own a house, the more money you are missing out in terms of the equity. And I'm not talking about just paying off the loan. I'm talking about the equity appreciation, that strong 5.44% that you could be making in terms of the home value of the house. Okay. So why would you want to rent out a house building the equity of someone else when you can be owning your own home and building your own equity? The next thing you need to consider when you're renting out a house that's a con is, first of all, your rental income is not going to be staying the same. 1 year from now or 30 years from now, your rental values are going to be increasing. So you are basically going to be at the mercy of the current market you are living in. Now, if we were to compare that with owning a house, your loan payment is going to stay the same unless you do anything to change it. Okay. The only real thing that's going to be changing are going to be your property taxes and your insurance rates. The final nail in the coffin when it comes to renting out a house and why I advise against it is this. When you rent out a house, you don't own the house, obviously. And because you don't own the house, you don't get to call the shots in terms of what happens to the house. You are basically at the mercy of your landlord. You don't get to do any extra things to your house. You don't get to add in new fences. You always need to ask your landlord to basically get approval for anything that you would like to do in the house, whether or not that comes into the form of adding a hole in the wall or adding any additional things to the home. So you really don't have the freedom when it comes to basically doing what you want with the home. Now, what are the pros and cons in terms of buying a house? Well, like we referenced before, you first of all get to ride the equity appreciation wave of owning the house. Your loan payment is going to be staying the same, at least when it comes to the principal and interest. And on the contrary of renting out a house, you get to do whatever you want with your property. If you own your house, no one's going to tell you what you should or shouldn't do to your house because it is your own home. You have a lot more freedom when it comes to doing things that you want for your house. The only real cons with basically owning a house is if you do buy a house, you're stuck with the house unless you sell the house or you rent it out. But even then, when you rent it out, you still need to make sure you make that mortgage payment because that is attached to you financially. Now, another con of buying a house is there's just a huge upfront cost when it comes to buying a house. And depending on the different loan programs, you're going to have to put different types of down payments and also closing costs for the home. So it's not as flexible when it comes to the financing options, whereas opposed to renting out a house just for the upfront $3,000 cost. That is all that I have for today's video. This is a little bit of a longer video, but I really hope I was able to tell you the difference between renting and owning a house. And either way, whichever one works for you the best and whichever one is most adaptive to your particular situation, that's obviously the best one. Now, if you're interested in buying a house, refinancing a house, or even selling your house, please feel free to reach out to me via phone or email. And that is all that I have for today's video.